Good morning, everybody. Welcome to episode 6 of Dealmakers from Crystal Specialist Finance. My name's Kris Corns, Operations Director here at Crystal, and today I'm delighted to be talking all things secured loans. In this series, we dig deeper into lender criteria and lender appetite, and we look to talk through the specifics of some cases that you might be looking at the moment. So therefore, I need some experts to help me to do that. And I'm delighted today to be joined by James Briggs, Specialist Account Manager from Together, Marie Grundy, Managing Director of Second Charge Mortgages at West One, and Crystal's very own Richard Bond. Good morning, everybody.
Good morning.
Morning.
Morning, guys.
And of course, we need you watching as well. So at the bottom of your screen, you have a Q&A button. So please do use that to send in any questions or scenarios you would like today's panel to have a look at. And of course, we'll do our very best to answer them on today's session. We do have a number of pre-registered questions as well. So please get your questions in nice and early so that we can get those covered for you in the session today. Okay, let's make a start. So very first question then. So James, if we start off with you for this one, just how busy is the second charge market at the moment and what kind of deals are you seeing being completed currently?
Okay, morning everyone. Just before I answer that, Kris, just like to say thanks a lot for hosting these events. I think they're a really important part of spreading the message of not just seconds, but all things specialist finance. So big props to you guys for organising them and putting them on so professionally. I think with the seconds market, it's recovered beyond our expectations coming out of COVID. Actually, you've been able to track the increase in activity and completions in the market in line with the restrictions easing. And we're not too far off pre-pandemic levels, which is really impressive. In the market, there's a great mix of bank-funded and non-bank lenders. So you've got a real kind of range of competitive rates through to innovative and flexible criteria. So it's a great competitive space to be working in. When it comes to the type of deals we've been seeing this year, in our personal finance division, we've been seeing majority debt consolidation. So about 71% of our cases so far this year have involved some element of debt consol. Some challenging income scenarios when it comes to income calculations and the source of income. And those kind of clients that don't fit the mainstream affordability and income box. In the commercial side of our business, we've been seeing lots of engagement from entrepreneurial clients. So clients that are looking to gear up existing buy-to-let properties using seconds for further property investment, business use, complex type transactions. So taking second charges across multiple securities. So it's been a real mix and a really exciting place to be.
Thank you. And Marie, how are you seeing things?
Yeah, very much along the lines of sort of James' recollections, actually, because like James, we have really been pleasantly surprised with the speed of the recovery, because the second charge market clearly was hit quite badly during the pandemic. And in the same way, James has seen, really sort of exceeded our expectations also in terms of the speed of that recovery. In fact, last month we achieved a record month for lending, which is a fantastic achievement given, sort of where the levels of lending were around this time last year. And again, I think, yeah, absolutely, debt consolidation is always sort of a mainstay of second charges, particularly because second charge lenders take all reasonable steps to discharge the debt directly, which means that from an affordability perspective, we don't have to double count the unsecured debts within the affordability assessment, unlike the way that affordability assessment will be done in the high street. But then we're also seeing other non-stereotypical second charge borrowers coming to us, particularly around demand for larger loans. So we're seeing borrowers come to us because they want to buy a second property, or they want to invest into a buy-to-let property as an example. So they use a second charge to raise a deposit or an outright purchase of that property. And that's driving some sort of bigger loan sizes into the second charge business, which is something we're seeing on a repeat basis as well. And I think also you've got borrowers that unfortunately have been impacted during the pandemic, which means that they've got typically a preferential rate with a high street lender. And then by looking to raise further finance, it may mean that the only option to them is to remortgage away to a specialist lender. And that means they're obviously going to sacrifice a lower rate of interest on the bulk of the borrowing. So that's another reason. And then the other driver, I feel, is the growth of the product transfer market, which, you know, is outstripping remortgage activity in most quarters now. So if you've got borrowers that have recently completed a product transfer, their additional borrowing needs are not typically addressed at the point of that transfer. So that's an opportunity for intermediaries to revisit those clients, particularly as a lot of those transactions are done on an execution only basis. So we all know that lenders are getting more aggressive in their contact strategies, trying to reach the customer first. So it's a great way for intermediaries actually to include second charges within their armoury, so that they have the opportunity to revisit those client banks and keep that relationship alive. Because that's critical, I think, now, the way that the structure of the mortgage market is moving. That's something intermediaries really need to be quite mindful of, I think.
Excellent, thank you. And Richard, same to you.
Yeah, I mean, the market's buoyant at the moment. We've seen a fair amount of activity from our broker partners. I mean, in terms of the types of business we're seeing, the guys have already touched on it. So we're sort of seeing the usual suspects of the debt consolidation, home improvements. But as Marie's just touched on as well, we are seeing, especially on the buy-to-let side of things, the capital raising on the main residence for buy-to-let purchases. So I think that's something that's definitely going to continue to grow.
Thank you. So Marie, starting with you for this one, there's still a perception by some out there that second charges are complicated to arrange. How do you overcome this, and where's West One's focus?
Yeah, I think actually, I think what I really would like to get across is the fact that a second charge is a mortgage. It just happens to be a second mortgage. It's either a first or a second mortgage. The distribution for second charges is typically quite different, because it's like anything else. We all know how extremely busy intermediaries have been over lockdown, and their focus generally is on purchase and remortgage transactions. And we all know, even from selling protection, a lot of intermediaries just don't have the time to do all those things together. And I think that it's important to just really spell out the different routes to second charges. So you have, for example, with a number of lenders, we're not one of them actually, but with a number of lenders, brokers can go directly to a second charge lender and arrange that. And they will obviously have quite a bit of work to do in terms of providing the information that second charge lender requires. The other more simpler route actually is just to hand off the responsibility, both from an advice and a processing perspective, to a specialist second charge broker. So somebody that is, you know, their core business is centered around second charges. They know the market inside and out, and the broker can literally hand off that client to that second charge broker, obviously without the risk of losing that client, because, you know, we all, you know, as a second charge master broker, we need to understand where the ownership of that client lies. Or the other alternative actually is if the intermediary wants to retain the advice process, they can do that also. So they can use the second charge broker's knowledge to obviously provide research and evidence to identify the most appropriate product, but then hand off the processing element of the second charge to a specialist. And hopefully that will be a much more streamlined process, particularly when you bear in mind, unlike a remortgage transaction, most second charge borrowers don't have any legal representation during that process. The legal work is done between the lender and the broker. So it doesn't get to a point where you know, I've had it with other family members where they've had a very speedy mortgage offer for a remortgage, and they've got that typically in a week, but then it's taken another 8 weeks to complete because it's been farmed out to a panel conveyancer, and the service levels are obviously not brilliant. Whereas with a second charge, typically once the offer's issued, the loan will go on to complete very quickly within a matter of days. So I think the key thing is work out whether you've got the time and the resource and the capacity to deal with the second charge process yourself. If not, use an expert, which will make it a lot quicker and more streamlined overall for both the customer and the broker.
Excellent, thank you for that. And James?
Yeah, Marie's answered that very comprehensively. We are one of those lenders that's got different channels to access the products. The vast majority of our second charges come in through our packager partners. So those are the guys with the expertise. They know exactly what we're looking for on cases. They have access, as you guys do, to our affordability calculations, our valuation criteria, our internet-based valuation bypass, and you prepare a case for us, send it in to us, and we see a lot of same-day offers. So that packaging quality is really important to us. It helps our efficiencies, and it helps us to provide more competitive products into the market. Just to expand on something Marie did say, there is a historic perception that seconds are more complex than firsts. But let's not forget that Crystal, for example, acting as the packager, you're doing the work of the packager, you're collating the administration, but you're also doing the work that a solicitor would do on a first charge transaction. So there might be more requirements, but you're catering for all of those lenders' requirements instead of in the first charge world, half the requirements coming from a packager, half the requirements coming from a solicitor. So you guys are doing the title checking, the lease checking, consent from the first charge holder, dealing with any restrictions, cautions, unilateral notices, all that complex stuff on the land registry that a solicitor would do. You're taking care of that. And I think that's sometimes why seconds feel more complex, because it's one source collating all of the lender's requirements instead of two. But we've taken quite a few tech measures since we launched back after COVID to try and make processing easier. So two of the big enhancements that we've made recently are paperless direct debits, so bypassing the requirement for any paper DDs and any prevailing errors that we might see on those. And also we've got automatic income validation through HMRC and Equifax for employed applicants. So at the push of a button, we can validate a client's pay slips, which doesn't necessarily bypass the requirement for the packager to collect that information as part of KYC, but it's less information to send to us, less documents for our underwriters to assess, and it speeds things up, increases our efficiency. So that's kind of the start of our tech journey. There's lots of other stuff going on behind the scenes to make life easier for clients, brokers, and packagers.
Brilliant. Thank you. So Richard, having heard the areas that packages can add value then, what part can Crystal play in that, and why should the listening audience consider using you and your team?
I think obviously both of the guys have touched on that. Obviously there's a perception that secured loans are complicated. Some are, there's no denying that, but on the whole, as has been touched on, they are just another form of a mortgage. Obviously, what we offer at Crystal is a wealth of experience. We've got underwriters through to Anne, who picks up the case and will hold the hand, be involved with the broker as much or as little as they want. And then obviously we just act and take you from start to finish. Obviously, we understand the importance of getting things right first time as well, because we know that obviously our broker partners, they don't want to be going and making multiple changes with their clients. So again, giving the broker that certainty of decision is vastly important for us. I think secondly, flexibility. We know what the lender's like and we know what they don't. And as much as we pride ourselves on getting things right first time, things do and can arise during that process of the application. So again, we offer the flexibility that we can switch lenders quickly and smoothly to make sure that when that does happen, the application process obviously isn't disrupted. I think thirdly, it's about ease of use. Again, as I've touched on, there's sort of an element of unfamiliarity with sort of potentially using these secured loan lenders. And we've got this fantastic system that's been out for a while now. It's the hub. It's so easy to submit inquiries online, literally takes minutes. You can book an appointment with an underwriter to suit you. You can even apply online. And I think, again, that literally takes a matter of minutes. All I'd say is that if you've not tried it yet, give it a go and sort of see how easy it really is. And that's not just for security, it's for everything across the board.
Excellent, thank you. So James, starting with you with this one then. So with the majority of second charges being regulated, obviously there's less flexibility there than can be found in other areas of specialist finance. Can you give us a quick overview of the flexibility Together are able to offer in that space?
Sure. Yeah, I wouldn't necessarily say there's less flexibility because we're regulated. So I personally embrace regulation. Anything that makes seconds fall in line with firsts, and all the paperwork and familiarity is there, then I think that's a great thing. In terms of flexibility, we're one of the largest, if not the largest, non-bank lender in the UK, and because of the way we're funded, it allows us to be uber flexible when it comes to criteria. I'd probably categorise that into 3 areas. So the first one is income. We have no loan to income caps on our products, which can be really useful if a client's maximise their borrowings through their first charge with the high street. It allows them to top up their borrowing for any purpose. We'll use any benefit income the clients might be receiving. They might be receiving a combination of self-employed income plus benefits. We can use that. We can lend into retirement for applicants as long as they've got suitable provisions in place. And a really big area of our lending at the moment is lending to self-employed applicants. So that accounts for just over 50% of our entire lending in our personal finance division. Key USP for us in that area is we'll use forecasted income for the clients if they've got an accountant, which is really useful for those self-employed applicants who are coming out of the pandemic. Business is starting to improve, but they've not submitted their year-end accounts yet. So that's a key area for us. So that's income. Then security, so the types of security that we're lending against. So we're famous for lending against non-standard properties. So that could be non-standard construction, could be high-rise, ex-council high-rise, properties with lots of land. We have no limit on the number of acres attached to a residential property. And multi-use properties, so semi-commercial, very, very comfortable and relaxed about that. And we've seen a lot of investors moving towards the mixed-use type property because of the tax advantages of those types of assets. And finally, the flexibility around the products that we've got on offer. I think it's fair to say Together have been historically recognised as an adverse credit lender, helping clients that have got some form of medium to heavy adverse. It's true that's where we came from as a lender, but that's not representative necessarily of the lending that we do today. Less than 15% of clients that we lend to in our personal finance division have adverse credit within the last 12 months. So we've got now a waterfall of products from Prime Plus through to our standard range to cater for a wider variety of clients. And finally, on the product front, we've got interest-only options across the entire range for firsts and second charges. So if that's right for the client and interest-only is used in the correct way, that can be a really, really useful tool for clients and advisors. So really, to summarise, income, security, and products is where I see our key strengths in terms of flexibility.
Brilliant, thank you for that. And Marie? You're still on mute.
The wonder of Zoom. Yeah, from West1's perspective, I think we've probably got the most comprehensive range of products in the market. So a bit like James said, everything really from very prime clients who are very creditworthy. We don't credit score, we use credit assessment. So again, for borrowers that may fall short of varying credit scores, which we know are sometimes fine-tuned to be aligned to sort of operational capacity within lenders, and it may mean they fail credit score, but it doesn't necessarily mean that they're not creditworthy borrowers. So that's again something I think within the specialist second charge lending market, underwriting is done on a individual basis. So we really try and get under the bonnet of understanding a customer's individual circumstances, so we can understand what's going on from a credit risk perspective, and really try and work with that borrower's circumstances to try and find the right outcome for them. In terms of loan sizes, they're very flexible. We have loans starting from a minimum of £10,000 all the way up to £500,000, with larger loans considered by referral up to 750. We can also have flexibility in terms of loan terms, so we can take loans from a term of 3 years all the way up to 30 years. And the beauty of that as well is that the second charge loan term doesn't have to work in tandem with the first charge loan term. So the borrower has the option to take either a shorter or a longer term than they have on their existing first charge, obviously to meet whatever budget and aspirational requirements that they have there. We also have some other niche areas. So where a property is owned in a borrower's sole name, but they might be married or have a long-term partner, we can lend in those instances as well by keeping the second charge in the owner's name and not insisting on the other party being added to the loan. But then there's also the flexibility to add that second non-owning spouse onto the loan if they've lived in the property for at least 12 months, if they want to do that, obviously to create a little bit of flexibility around income. Like James mentioned, we also have some products where we don't have a cap on income multiples. And we also use ONS data to create a streamlined automated affordability decisioning process, which gives the broker comfort at the point of sale that the case passes our affordability assessment, which means they can work with the borrower on a much quicker basis. We can also use more complex income streams as well. So second job income is a good example of that, where somebody has 2 jobs and they don't, and the working hours are obviously plausible, and they've done that and they have a track record of doing that. That's something else we can take into account as well. So yeah, we really try and work with borrowers who are, like I said, very creditworthy borrowers, or borrowers that are underserved by the high street. So employed applicants with a shorter employment history or more complex income streams, self-employed borrowers, and retired borrowers as well, because we can take our loan term up to age 85. So there's lots of opportunities there for second charge borrowing with Westbourne and other lenders, obviously.
Excellent, thank you for that. And Richard, then very quickly, you've heard of the flexibility that the lenders are coming up with there. Can you give us a quick example of a piece of flexibility that you've seen so far this year?
Yeah, of course. I think in terms of the flexibility, we're not quite back to where it was pre-pandemic, but it is slowly coming back. I think obviously seeing lenders come back to the marketplace with increased LTVs and sort of the loosening of the requirements they implemented following COVID. But I suppose sort of to come back to the example, it was probably in relation to where a lender took a level of projected income, knowing that they had the security of retained net profit sitting in the background. So again, touching on what both the guys have said, they can do secured loan lenders can certainly look and be a little bit more flexible than maybe your standard high street lenders when it comes to sort of unusual income scenarios. So that would be the best one I've seen so far.
Okay, so you've seen impacts on things like furlough income, obviously going back 12 months, seeing lenders now being much more flexible with what they'll consider from that point of view.
Yeah, and as I say, the requirements are loosening. So whereas before there was sort of requirements for letters from employers, obviously in relation to the furlough, there was, trying to think what else there was. Well, as I say, the criteria has it's starting to come back to where it was sort of pre-pandemic, but as I say, we're not quite there yet.
Okay, and we touched on just very quickly for a minute or so. Then we touched on briefly the recovery that the sector's had. So Marie, you mentioned there that you had your busiest month. Was it last month?
Yes. Yeah.
So how do you think the recovery is going then?
I think it's going really well. I mean, we're still seeing really strong demand in terms of new inquiry levels and applications coming in. I mean, in the last sort of quarter, I would say it's been, from a pipeline perspective, it's probably the largest it's ever been. So we've really started to see that pipeline build and build over the course of the year. And actually, we've been really proactive this year as well. I think we've made around 4 different changes to our products and criteria, including, to your point, Richard, the return of 85% LTV lending, which we restricted during the pandemic. We're pretty close to back to where we were from a pre-COVID position. We've done that very gradually because obviously we've been very mindful of the recovery, the end of the furlough scheme, and obviously just waiting to see how that's all played out. But even from a macroeconomic perspective, you can see that the economy actually is performing really well. You know, we've gone from a position where, you know, a lot of borrowers were made redundant during the pandemic, and now people can't recruit quick enough. So there's lots of opportunities in terms of employment as well. So yeah, I think it's really buoyant. And I think, like I said earlier, there's quite a few drivers within the mortgage market, I think, that will continue to drive second charge business. We all know it's highly likely interest rates are going to start to creep up. So I would expect to see more borrowers wanting to fix onto longer term mortgage rates, which means, you know, down the line, those borrowers may then have further borrowing needs where it doesn't make sense for them to remortgage because it's going to cost them a fortune in early repayment charges. And the continued popularity of product transfers, I think next year there's going to be one of the biggest product roll-offs for a number of years. So remortgage and product transfer activity is probably going to be heightened in early 2022. So there's lots of opportunities to keep feeding and growing the second charge market.
Excellent, thank you. We'll pick up on that one in a second as well. Well, as it's 11 o'clock today, Remembrance Day has been observed with a 2-minute silence every year since 1919 across the nation. From peacekeeping missions to supporting the UK's response to COVID-19, our armed forces perform incredible tasks every day. This year, we're asking you to join us as we pause, along with the rest of the nation, to breathe and reflect on the service and sacrifice that the armed forces make on our behalf now by joining us with a 2-minute silence. Thank you, everybody. So we've had a few advanced questions come through, and I've seen some questions come through on the chat as well. So thank you for those. Please keep them coming in. That's what makes these sessions so valuable. If you've got cases on your desk at the moment that you're looking at, that we've got two experts here that we can raise those two straight away. So Andrew from Your Mortgage has asked the first one. So Richard, I'll probably start with you with this one. I've always looked at remortgage or further advance over secured loans. Isn't a secured loan normally more complicated and more expensive?
I think obviously secured loans have their places. It's going to be dependent on the individual client's circumstances. I mean, realistically, are they going to compete with a high street lender where the client's free to remortgage and LTV is relatively decent? Probably not. However, we all know that the vast majority of clients, they don't fit into these ideals. So I think where the clients had a change in circumstances, for instance, Marie's touched on the product transfer piece where they might have done a product transfer, tied themselves in, and now decide they want some funds, or for example, they've done a longer term fixed rate earlier in the sort of a couple of years back, and obviously the COVID pandemic hit and they've obtained adverse credit since taking out that original mortgage, and are looking to capital raise, so they don't want to impact their sort of the cheaper rates that they've got. Again, sort of capital raising as well for non-traditional purposes, sort of tax bills, higher loan to value debt consolidation as well is problematic sort of with the higher street lenders. So I think these are some of the instances where secured loans and the providers sort of like together, and West One really come into their own. So to answer the sort of the original question, yeah, I think sort of that they are more complicated. It can be more complicated, and yes, they can be more expensive when compared to sort of your traditional high street loans. But they certainly have the place, and certainly can add value to a lot of clients.
Yeah, excellent, thank you, James. Anything to add to that?
Not especially, no. I mean, we're not here to compete with the high street when it comes to further advance rates. You know, we're typically looked at where a further advance isn't available, whether that be because of income criteria or loan purpose, as Rich said. We've got record numbers of people in 5-year fixes at the moment, which presents a big opportunity. As Marie said, why are you going to take someone away from that if you can provide a second to tide them over and then revisit the circumstances when the whole tie-in period ends? And we've got as Marie said, also the record number of clients rolling off, and the number of brokers now that are offering the holistic service, doing the product transfer, but also simultaneously doing the second charge, and then the second charge affordability calculation benefits from the lower rate, the post product transfer rate. Using the two products in combination like that can be really useful. It has its place, but it's not right for all clients. But I suppose the most important thing is to consider it as part of one of the tools in your briefcase, because they can be really, really useful for the right type of clients.
Brilliant, thank you. Marie, anything to add?
Yeah, I mean, on the face of it, a remortgage and a further advance will always look like a cheaper option. It's not necessarily always the case, though. So, for example, if you are an intermediary, like James just alluded to, where you're not actually ever going to consider a second charge, you will always go straight for a remortgage option. If there's hefty ERCs, which quite often there will be, we've seen a lot of very attractive fixed rate products, but generally they come with some pretty hefty early repayment charges. That's not necessarily the most cost-effective way for a borrower to raise finance. And the other option actually is where a borrower might have an interest-only mortgage, and there are some lenders where if you then apply to them for a further advance, they'll only grant the further advance on the concession that you convert all of your borrowing over onto a repayment basis. So it becomes very expensive to borrow a relatively small amount of money, which might cost you an extra £1,000 a month as opposed to an extra £200, £300 on a second charge basis. So I think that's where it's really important that the quality of advice that intermediaries are giving really takes into account the full circumstances to make sure that a remortgage or a further advance really is the most appropriate product for that client.
Brilliant, thank you.
I'll just add to that as well. There's a lot of clients out there with legacy first charge products, very low base rate trackers. that clients really want to protect. And again, the high street are trying to get people off those products because they're not cost effective. So the second is a great way of protecting the existing mortgage product rather than refinancing someone and getting them into like a 2 or 5 year remortgage or product switch cycle with the associated fees, changing products.
Brilliant. Yes, there's some really good points there. So I think the takeaway for that one for Andrew is that it should be considered as part of that holistic solution for the client. And in some circumstances, it will be right to go down that route. And in others, the further advance or the full remo might be the better option, but they should all be considered and weighed up if you're providing the best advice for your individual borrower. Yeah. So another question has come in from Amir, which is a little bit more specific. Marie, start you off with this one. I have a client who has recently gone self-employed, so hasn't yet submitted an SA 302. Are you able to consider their current income position?
In a word, no. You know, like any responsible lender, we need to be able to evidence a track record of income to make sure, you know, that, you know, looking at that, how would we be able to evidence and assess that borrower's income without having some submissions to HMRC? We, as a lender, actually ask for a minimum of 2 years SA 302s to make sure that the business is stable and that future earnings are in line with current ones to fully understand the affordability position. So yes, unfortunately, we wouldn't be able to lend to a borrower in that instance.
Thank you. James?
Yeah, same answer. Unfortunately, it's a not yet. So we have a requirement for 2 years SA 302s, same as West One. However, if the clients have got an accountant and the accountant's reviewed the client's business and can provide a certificate, that reduces to 1 year's trading. So okay, we'd consider lending to that borrower, but they'd need their first year's trading to be completed.
Okay. And is there any flexibility there around the last year's trade? Obviously, with 2 years SA 302s, the last pandemic year, there might have been lockdown issues for them or reduced income, whereas there might be a better picture that we can see either the year before or the year after. Are you able to take a view on that balance?
Good question. Yeah, so my understanding is some of the high street lenders out there will average out or take worst year over the past 2 or 3. With Together, we use the most recent year, even if that's increased. And if they're more than 6 months into their current trading year, we'll use the forecasted income from the accountant. So that can be really useful for those clients whose businesses are recovering post-COVID.
Brilliant. Thank you. And Marie, only fair I send the same one back to you. How would you view the 2 years income from there?
So we will usually have a tolerance of 20% increase in earnings from the previous years. If it usually exceeds 20%, we will tend to take an average of the last 2 years SA 302s. However, it does come back to the whole point around flexibility. So if the increase in earnings actually might not be related to the pandemic, or there's a reason for that. For example, I think we had an inquiry where it was a business that had been established for a number of years and their income had dropped the previous year because they'd used profits to acquire some commercial premises. So by looking at the 18-19 SA 302, we could see what the pitch looked like 2 years back, what it looked like now, and then take a view. So we do try, like I said, to really understand a borrower's individual circumstances, but typically we will have that tolerance there of 20% just to make sure that we're not lending on unsustainable income figures going forward.
Okay, thank you. And that shows the benefit of specialist lending, that underwriters can take a view on things and it's not just a computer says no approach to putting a figure in a box. Yeah. Brilliant. So we've had this question asked a couple of times, both in advance and through the chat today. So Iridar, thank you for your question there. How do you view buy-to-let second charge loans? So Marie?
Yeah, we're one of the few lenders as are Together that actually offer second charges for landlords. So we can look to lend up to £250,000 up to 75% for individual landlords. So we don't currently lend to limited company or SPV borrowers. And we can do that on an interest-only basis as well, so with a plausible exit strategy, and it can be for any purpose. So typically we see requests for home improvement loans to renovate the property, to increase rental income, or actually to increase property value. We see landlords using it to raise further deposits towards further buy-to-let purchases, or they can use it for personal use as well. So we don't restrict the loan purpose just for buy-to-let, and they are a very popular form of borrowing, and obviously it provides flexibility, particularly where in the buy-to-let world the opportunities for further advances are a lot more restricted. So it does create more opportunities for landlords, and typically because of the affordability rules that are in place, you have a lot of landlords that are locked into 5-year fixes, or to James' point, are benefiting from really low base rate trackers that are legacy products. So lots of opportunities there for landlords, and the assessment of debt service cover is very simplistic as well. So we work off a 125, 145, 165% rental income assessment. So very straightforward. Coming back to the whole issue around complexity of second charges, buy-to-let second charges are actually quite simple to arrange as well, but they're probably a lesser known product, and it definitely is an underserved area of the market.
Thank you. James?
Yeah, thank you. I think Marie's spot on. There's loads and loads of borrowers out there with 5-year fixes on buy-to-lets, not necessarily because that was their preference, but because they needed a 5-year fix to get over the debt service hurdle. So there's a big opportunity there for clients who've seen some capital growth, some capital appreciation, but want to tap into that, but it doesn't make sense to refinance. So buy-to-let seconds are definitely a big area of the market where there's significant potential. We will lend on to clients who've got consumer buy-to-lets, so the accidental landlords, typically couples where they've retained one of the properties and moved in together. So we can capital raise on those. On those type of transactions, we base the affordability purely on the rental income that asset generates. And then we've got your traditional, your non-consumer, your commercial buy-to-let properties. And we will lend to individuals on their 125 or 145 according to their tax status. But we've got a lot of flexibility on other applicants. So we'll lend to SPVs, which used to be specialist, but is becoming more mainstream now with correct taxation advice for purchases of buy-to-lets. We will lend to trading companies, trusts, charities, pension funds. As long as we can get personal guarantees on the individuals that sit behind the entity, we're very, very flexible about who we will lend to. We're also doing a lot of lending to expats and foreign nationals who have buy-to-let assets in the UK and have an appetite to grow portfolios, don't have any UK income, but can gear up those existing investments for further investment. And you guys at Crystal, as one of our gold partners, have access to exclusives across all three, so consumer, commercial, and commercial property investment. So thank you for your support in that area.
No problem. So Garuda, hopefully that answers your question. There's flexibility around both property type and use of funds for that as well. So certainly pick up the phone and speak to one of our guys, and let's see if we can get that one done for you. We've had a question come through from an anonymous attendee on this one. So prior to COVID, the LTVs available for second charges were quite high. What's the current maximum LTV that you can both offer? So James, do you want to start us off with that one?
Yeah, this is a quick one. So 75% LTV on residential property and 70% on buy-to-let property.
Brilliant. Thank you. Marie?
Yeah, we reintroduced our maximum LTV of 85% back earlier in May this year, and that's for our residential borrowers. And for buy-to-let, we can go up to 75%, which again was our pre-COVID position, so exactly where we were pre-pandemic on both product lines.
Excellent. Thank you. Richard, anything to add to that?
No, the guys have covered everything.
Excellent. Thank you. A nice quick one there. So Callum's asked a quick question, again, hopefully another quick one. Any minimum time in ownership of the property? Marie?
Yeah, typically we ask for the borrower to be in situ for 3 months in the property that they live in, but with a mortgage history of 12 months. We always like to see 12-month mortgage history, usually a minimum of 3 months in the property. If there are some extenuating circumstances, for example, it may be actually they've downsized, the mortgage payment is reduced, so we're comfortable, we've got a track record without insisting on the 3 months. We can sometimes look at those on a referral basis. But yeah, 3 months is our normal standard of time in property.
Thank you. James?
Okay, so if we're lending to a first-time buyer and it's their first ever property, then we'd want them to be in there for 6 months and see 6 months history. Other than that, there's no minimum time in property. And to take that a step further, we're seeing a lot of delays at land registry at the moment because of COVID. So I can see you nodding furiously there, Kris.
Yep.
Very frustrating if you get an applicant who wants a second charge. They purchased the property 3 or 4 months ago, land registry hasn't been updated. We will still lend in that scenario with an undertaking from the client's conveyancing solicitor that they'll register our charge and update land reg with our charge when the ownership title's updated. So no minimum time in the vast majority of cases.
Excellent. So again, just underlines the flexibility there that's available from all lenders really on the specialist panels, which is brilliant to see. So David,
sorry, Chris, I think just one thing, obviously, for our broker partners to be aware of, obviously, it would be something that we do come across. Obviously, sometimes the lenders don't have an issue themselves. It's the first charge lender. So obviously, normally a lot of those do require at least 6 months ownership before they'll grant consent. Although we do have a couple of lenders that will look at taking equitable charges without consent. Obviously, you're going to be looking at lower loan to values on that front, but obviously that's just one thing to bear in mind. Maybe get the clients to check with their first charge lender whether or not they will grant consent prior to the 6 months ownership.
Very good point. Thank you. It was worth interrupting me for that.
Sorry.
That's good. David's asked, he's got a client with some adverse that's impacting his ability to get him a standard remortgage. It's probably a very complex area to go into quickly on this call, but James, how would you view adverse?
Yeah, so we classify adverse as demerit points. That's our definition of adverse. So we've got our standard products cater for clients with 3 demerit points. So that can be a combination of mortgage arrears, CCJs or defaults within the last 12 months. And we don't credit score any of our products, and we don't have any criteria on our standard products around unsecured adverse. So the client falls within that and it's responsible to lend to them, it puts them in a better financial position, then definitely a case we can consider. Brilliant.
Thank you. Marie?
Yes, so we have sort of 3 tiers of products with different parameters around adverse. So as James has just mentioned, and I know we've mentioned this earlier, the fact that there isn't a credit scoring process in place is really helpful in this scenario. But we have products that cater for borrowers who may have had some unsecured arrears. So I think the critical thing is just understanding what's led to those arrears. Will the loan put them in a better position, or have the issues that led to those arrears gone away? So I think that's, from an advice perspective, something that our brokers will obviously pick up. But we have flexibility around unsecured arrears for small CCJs and defaults below £500. Even if they're not satisfied, we disregard those as well from a credit assessment perspective. We don't take into account any sort of defaults relating to comms suppliers or public utilities either. And on most of our products, we expect to see at least 12 months mortgage history without any missed payments, but we do have a product that also caters for borrowers that may have a missed mortgage payment in the last 12 months. And also some more recent CCJs and defaults up to a value of 1,250 that are not yet satisfied. And also we can look to help borrowers who've previously been or are currently in an IVA or a debt management plan. So if they're using the loan to repay an IVA that's being conducted satisfactorily, or a DMP, we can help those clients, or clients that have historically had one, it's been repaid. And just again, it's all about understanding the client's circumstances and making sure that, you know, we've not got somebody that's repeating the same mistakes continually, because a second charge is not going to be the right answer for those clients. But if we can see it's really going to put the client in better financial position and not a worsening financial position. That's a critical thing from a credit risk and responsible lending position.
Thank you. Richard, anything to add to that?
No.
Thank you. So we had another question, again, sticking on the suitability point from Rebecca. I need to raise some capital for a client, but there's only 9 months until their fixed rate comes to an end. A second charge is obviously cheaper than a bridge until I can refinance this in full. So seems like the best advice, but are there any issues with me doing that on a short-term basis? So Marie, do you want to pick that one up first?
Yes, there is. It's not the right thing to do for the client. Second charges are not cheap bridging finance. And if the intention is to refinance the client after such a short period of time, it's definitely not the right advice for the borrower. You know, there are costs incurred in terms of valuation, advice fees, etc. So for me, that would not be best advice at all for that client, and it's not a deal we would, you know, look to complete on that basis.
Okay, thank you. James, anything to add?
Well, I'm not an advisor, so I can't say whether it's the best advice or not. You know, anything that I say here shouldn't be taken as advice. We do have a product that would cater for that type of scenario with no early repayment charges. Ideally, a lender wouldn't want to put too many of those cases on the books. And you know, one of the things that commercially you should speak to the client about is commission clawback. But that, you know, they would very carefully have to consider the setup costs, the lender fee, the valuation fee, as part of the overall advice, and how important it is for the client to raise the funds now rather than wait. We don't know what those clients' circumstances are or how urgently he or she needs the money. It's difficult to give a definitive answer, not being an advisor, but on the face of it, we do have a product that caters for that type of circumstance.
Excellent. Thank you. Richard, anything to add to that?
No, I get, obviously James covered off probably the one unknown, which is obviously the commission clawback. It's not something that's probably well known, but unfortunately does happen. Whether or not it's best advice, again, it's going to be dependent on circumstances. I think obviously certain lenders won't want to do that type of business because it effectively is short-term lending, and that's what bridging is ultimately there to do. So I think it would depend on lender circumstances, but again, I think that's sort of where we can add the value. If pick up the phone, have a chat with us, we'd know which lenders potentially would consider this type of deal, and if not, we can certainly try and get you the cheapest and most suitable short-term finance that's available.
Excellent. I think the answers to that sum up a lot of the theme that's run through this, which is back to suitability. It's about understanding what that client's looking to do and then finding the right place for that to go, rather than automatically shoehorning them down one route, or because it's the normal thing that you do from there. So for me, that's one of the big takeaways from this session here, is to properly understand what your client's looking to achieve and then go away and match that with what's available within the market. So very useful.
I think so as well, because obviously the risk that you run if you try and shoehorn it down, for instance, like Marie covered, is that you might get sort of 90% down the road, it then comes to light that obviously it's going to be used short term, and then it ends up getting declined by the lender, which then will have incurred the client cost for no reason. So it's a tricky situation, that one.
Yeah. So back to the right.
Sorry, just to add to that as well, I mean, one of the things we do look at is the incidence of early redemptions, and then try and link that to see if there is an issue around advice suitability. So I think it is quite an important point to raise, but yeah, obviously lots of different views here, which is always good, but it is a very interesting question, and I'm grateful that they brought that one up.
It comes back to being right first time, isn't it? Both with the advice, with the lender that you're dealing with the suitability of that product, rather than incurring issues further down the line.
Exactly.
But, yeah, we're running short on time at the moment, so certainly thank you for all the questions coming in. If I can just ask each of you then, which has been your favourite deal that you've seen fund so far this year? So James, do you want to start us off there?
Yeah, so we funded a deal last month for £500,000, second charge, older borrowers in their mid-60s, I think they were, and they wanted a 12-year term, so taking them into our definition of retirement. Big residential property, strong post-retirement affordability, and they wanted to buy a second home and a boat. So a place in Scotland, which ultimately they're going to retire to. From a plausibility point of view, it worked for us on interest only because of the level of equity that they had in their current residential property. Plus, the funds were being used to purchase a second home as well. So we can see that there's a property to downsize and move to when they're ready to move to one residential property. So yeah, nice chunky second charge completion last month. Yeah, I think a lot of advisors historically are of the opinion that seconds are for adverse clients, small loan sizes, debt consolidation, and hopefully Marie's talked a lot about kind of large loans. Hopefully, kind of the perception will start to shift that they're a really useful product as part of holistic advice. So yeah, we do like the big second charges as well, and that was one that we funded last month.
Brilliant, thank you. And Marie, your favourite deal that you've seen fund so far?
Yeah, we funded a deal for a rock star earlier this year with a group I used to listen to a lot in the 90s. So that was a very interesting deal. And again, it was, I think, for about £350,000 to purchase a buy-to-let property. But again, quite interesting in terms of the income streams because they were pretty non-standard. So there was different income streams in terms of royalties and sort of upcoming commitments for the guys. So it was an interesting deal from an income perspective, and yeah, not the typical standard second charge that you see every day, but a good one to get over the line.
Brilliant, thank you. We won't push you too much on who the band was. And Richard, your favourite deal?
Yeah, I think so. This was a deal we strangely completed with one of the lenders we've got on today. We had some clients that wanted to raise 150,000 on a second charge on the main resi to finish an extension of building an annex in the back garden and putting a pool and gym in it. So it's quite a nice annex. There was income issues basically due to a large increase in the client's self-employed income over the last 12 months. The lender had concerns over the long-term sustainability of it, and worked tirelessly with the lender's underwriter, worked closely with the broker and their clients to provide the necessary information and documentation to ensure that we could satisfy the underwriter's concerns. And it went on and completed, and we've got a really happy broker and client.
Excellent, thank you. Some real nice examples there, which again, all of which go towards kind of blowing up that image of a secured loan being £30,000 for credit card debt and that kind of thing. So there's many more scenarios that you can use these loans for that people might not have considered. So hopefully, if you take anything away from this session today, we've got the suitability, and then we've got the flexibility around use of funds, income, etc., that you can use when you're looking at your clients' scenarios as well. So really helpful. Thank you everyone for your input today. So time flies when you're having fun, and that does bring us to the end of today's session. So James, Marie, Richard, a huge thank you from me for being my esteemed panel today and for sharing your knowledge and experience of the industry as well. Hopefully everyone found that useful.
Thank you very much for having us. Really
Thank you.
appreciate it.
And thank you to all the attendees for watching, and thank you for your questions. Hopefully we'll see you again on one of these soon. So from me, all that's left to say is thank you. Stay safe, stay busy, and see you all again soon.